नमस्ते। सभी को स्वागत किया है मेरे यूट्यूब चैनल से। और आज आप लोगों के साथ बात करेंगे स्टॉक इन्वेस्टिंग फॉर बिगिनर, हाउ SIP रिमूव द बिगेस्ट रिस्क। यू डोंट रीड द परफेक्ट टाइम मार्केट forecast for a big lump sums to start investing in stock. A simple SIP approach can help first-time investor build equity exposure with far less risk and far fewer mistakes. For most first-time investors, the stock market feels intimidating for one simple reason: it seems to reward people who know when to enter and punish those who get their timing wrong. This fear keeps many young earners parked in fixed deposit and saving account for years, even though they know equities are necessary for long-term wealth. The reality is that very few people, including professionals, can consistently time the market. This is the precisely why a systematic investment plan or SIP works so well for beginners, not just in mutual fund but also in direct stock. And it is the core. A stock SIP simple means the investing a fixed amount of money into selected share at regular interval, usually monthly, regardless of whether market are reaching or falling. Why SIP work better than lump sums investing for beginner? The biggest enemy of a new investor is not market volatility, it is the emotional decision making. When market rise, the people rush in; when they fall, they freeze or panic sell. SIP remove this the behavior traps by timing investing into a routines you buy when prices are high. You also buy when prices are low. Over time this averages out your purchase cost and reduce the risk of the entering the market at worst possible moment. The discipline is especially important in the direct stock investing where price swing in individual companies can be served on the uncertainly. Step 1, decide how much you can invest every month. Before packing the stock, decided on the amount you can invest comfortable every month after accounting for the expensive insurance premium and emergency saving. This should be money you do not need for at least 5 years. Equity investing only work when you give it times when excellent companies can go through multi-year dull press. Many beginners start with just 5,000 to just 10,000 a month and gradually increase this as their income grows. Step 2, keep your stock list small and boring. A common beginner mistake is building a portfolio of 15 to 20 stock based on tips, social media posts, and news headlines. This usually ends in confusion and poor monitoring. Instead, start with just 3, 4 to 5 high quality, well established companies with a stable businesses, strong balance sheet, and a long track record. Think banks, consumer companies, large IT firm, or core infrastructure names. These are not exciting story, but they are far more forgiving if you make the timing of violation mistake. Step 3, fix on date and the automatic everything. Pick a date. Say the 5th or 10th of every month soon after your salary is credited. On that's the date, invest the same amount into the same set of stock. Most brokers are now allowed to the automatic stock SIP so that process become mechanical rather than emotional. This less you interfere that the better your result usually are. Step 4, don't overtaking violation every month. Step 5, review the business, not the share price.